Hello and welcome back to Lean on Success, where process improvement is self-improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt. And if you notice, there's another face on the screen today. I enlisted help from one of my dear friends, Mr. Chris Hollister. Chris, how you doing tonight?
Ben, it is excellent to see you, sir. Thanks so much for joining me. I've been a big fan of the show for a while now, so thanks for having me on.
Well, I couldn't do this without you, so I appreciate you taking the time to come on.
Oh, hey, the price was right, so I had to do
it. Oh, I paid you double what I paid you last time.
That's exactly right. Yes.
So just to give our audience a little bit of background for those who don't know you, so you and I, we met kind of at work by accident.
We did. As a matter of fact, we met through our friend Jonathan Oakes, who introduced us. And then also, I met you, or I knew of you before you even knew it, because you were that guy in the cafeteria that was playing Magic the Gathering.
Yes, I was that nerd
And
playing
I
Magic
was
in the
like,
cafeteria.
who's playing Magic the Gathering at a work cafeteria? And then part of me was like, man, I wish I had the guts to play Magic the Gathering in the work cafeteria.
Yeah, I was embracing my full nerd at that point. So we
Hey,
got to know each
respect.
other, and we did a ton of work. We've co-hosted podcasts together, and we've played a lot of hours beating each other in board games. I think that's what really forged our friendship was on tabletop board games.
You beating me more than me beating you. That's for darn certain. I am absolutely. I am second place as the first loser.
So I brought you on today because I wanted to, like I said, we're continuing our series on the recession, and
Yes.
I've been having some questions, and you and I have even talked a little bit about the 2008 financial crisis, which is a little bit different than what we're going through today. But I thought that based on the things we've been talking about with the recession and unemployment and the housing market, that it will be good to kind of illustrate how we ended up in the Great Recession last time. But in this story, I'm going to use tacos as the analogy here.
Now you're talking. Now I see why you invited me on here. If there's somebody that likes a good taco, it's this guy. How you doing?
Absolutely.
Yeah.
And so we're gonna do this kind of in a parable. So
Okay.
You are gonna be the main character in this story. Okay.
All right.
So I want you to imagine. I want to take you back to your call center days. Okay.
Okay. Got it.
You're in a call center. This call center has 10 floors, and you work in a department with roughly 100 people. Right now, this call center, you get paid every week, and your take home pay, everybody's take home pay in your department is about $400 a week. Okay.
Okay.
And everybody gets paid on Friday. Now, of course, when people get paid on Friday, by Wednesday, everybody's broke, right?
That's true.
You got a little money in your pocket. You got like $25 you've been saving up because you're going to play some poker this weekend, so you got your poker money saved up.
There you go.
But something interesting happens at work. People notice outside that a truck is pulling up, but it's not just any truck. It is a taco food truck. Now, of course, there's a lot of buzz in the news because everybody likes tacos, right? I mean, it's tacos.
Who doesn't like tacos? I mean, come on. It's meat, it's cheese, it's shells, it's sour cream.
Right.
Enough of that vegetable stuff. Yeah, it's perfect.
It's everything everyone loves.
It's the perfect food. Let's just be honest.
It really is. And so because everybody loves tacos, now people are trying to figure out, okay, well, I brought my lunch today, but I really want some tacos, but I ain't got no money. So your friend comes up to you, your very close friend that you work with a long time, says, Chris, these tacos are $5. I don't have any money. Can I borrow $5 from you until Friday? And, so basically he's saying, loan me $5, right?
Yeah.
So you're like, okay, well, but this is my poker money, dude. So, I really need this back. He's like, I promise, if you let me borrow $5 today, I'll give you $6 when we get paid on Friday.
Oh, I'll gladly pay you Tuesday for a taco today.
For a taco today.
Yes.
Exactly. I'll gladly pay you Tuesday for a taco today. And so you take that deal. It's like, okay, hey, that's cool, man. I trust you. Just pay me my $6.
What? Yeah, 20% increase.
Yeah.
I mean, return of investment. There you go. I mean,
There you
that's
go.
about all I know, math and economics wise. So there you go.
You nailed it. You nailed it. So you give him the money, and he gets in line to get his taco. Now he's coming back, and of course, people see him eating the taco, and they're like, "Where'd you get money from?" He's like, "Well, my friend Chris let me borrow money." And so you get like 4 more people to come up to you and say, hey, loan me $5.
Oh, jeez.
And so, but I mean, these are people you know, right? These are your coworkers. They're on the same team.
Right.
You're nice. You want everybody to enjoy tacos because everybody loves tacos.
True, but I got my PB&J because I had my money
Right.
for poker money, man, and yet
Exactly.
all these people are
Exactly.
eating tacos in front of me. What the heck?
Well, there might be a solution for that.
All right.
So you loan the rest of your money out, right? So now you got, and everybody says they'll pay you $6 on Friday. So you loaned out $25 to
Right.
5 people. They've promised to pay you 6. So you got $30 in IOUs, right?
Sure.
So all is good. So now they get their tacos. Well, then somebody else comes up to you. So you got like 10 more people now by this time that have heard that you're lending out money for
Oh
tacos,
my gosh.
but you're out of money, right?
Yeah.
You don't have any more money, but you're like, well, I want a taco too. So you go to your boss. You say, okay, boss, I'm getting paid $400 on Friday. I got all these people. I got like $60 worth of IOUs here for people promising me to pay on Friday. So I want you to give me an advance of $50 on my I want you to advance me $50 from my paycheck, and I'll pay you back 55 when we get paid on Friday. Right. So
Okay.
now you get an advance of $50 on your paycheck. You lend that $50 out. And not only are you going to get $60 back in IOUs, you pocketed an extra $5 for yourself because you only got to pay back 55 back to your boss.
Right.
So you've got an extra $5 for you to buy a taco next time, right?
I've got a racket going, is what you're saying. Absolutely.
Exactly.
Yeah.
So Friday comes, everybody gets paid, everybody pays their debts, everybody had tacos, everybody's happy, right? Everything's good. Now next week rolls around, and on Wednesday, that taco truck rolls up. Nobody has any money, right?
That damn taco truck.
Hey man, he's coming back. You had a lot of business last time, right?
Yeah, that's true. All of my business.
All of your business. Well,
That's right.
now last time you had like 15 people, like your whole team came up to you. Well, now half your department has gotten word that Chris got the hookup, right? So now you got 50 people coming to you asking to borrow $5, right? They all ask to pay back, $6. You go to your boss and you're like, hey, I need a bigger advance this time because, everybody wants tacos and you want people to enjoy tacos. And your boss is like, okay, cool. So he advances you the money. Now this time you got to pay back a little bit more because you borrowed a little bit more. So you say, okay, let me borrow $250. I pay you back $285, right? But I'm getting
Okay.
$300 in IOUs. So you make $15 off the deal. Your boss makes $35, right?
Sure.
Friday comes, everybody pays their debts, everybody's fine, right? So now week 3 rolls around. So by this time, your entire floor gets word and they all want tacos and they know that you got the hookup.
And I'm getting stressed out here, man. I mean, I'm pulling out what's left of my hair. So, oh man.
Listen, remember,
right.
you've been making money off this deal,
No,
right?
I hear you, but man, there's just like I'm having to go to my boss. I'm having to stress out saying, look, I need this now, and
Well,
hope that she says yes. I mean, the whole
well, by
bit.
this time though, your boss is kind of enjoying, making a little bit of cash off of the event because you're getting your paycheck every Friday. She
Yeah,
knows the money's coming in, so she knows
true.
she's getting paid back. So your
And
boss is
yeah,
like, hey, bring me some more of these. Make some
true.
bigger loans.
Yeah, and not having to. I mean, she's not having to do work. I am.
Well, there you go. So
Yeah.
now you got the whole floor. So now you got 200 people that want tacos. So you got to come up with $1,000. All right. So you go to your boss, is like, okay, we need to come up with $1,000. Your boss is like, well, I can't advance you that because your paycheck's only $400. So you're like, okay, well, look, this is what we'll do. I'm going to put up my paycheck as collateral, and I want you to let me borrow some of your money in order to get these tacos, right? So I want you to give me the 1,000. I'm going to put up my paycheck as collateral. Go ahead and loan me the 1,000. Your boss is like, okay, well, okay, if I do this, now you're going to have to pay me back 1,100, right? It's because the stakes a little bit higher. You need to pay me back a little bit more. You're like, okay, no problem. You borrow the 1,000. You got $1,200 of IOUs now because you got 200 people, $6 each. You make 100. Your boss makes 100. Friday comes, everybody pays their debts, everybody's good, right? Next week rolls around. Well, by this time, there's so many people buying tacos. Now the taco truck has to hire more help, right? He's got to get an 18-wheeler now.
Oh my gosh! All right, rock on.
He's got to hire more help. So guess what? Guess what that does to the price of tacos? right? Now tacos are going up. They're not $5 anymore. Now they cost $7.
Oh boy.
Right? So, but everybody still wants tacos because everybody loves tacos, right? So the deal goes from borrow 5 and pay 6 back. Now you're going to borrow 7, but you got to pay 10 back, right? Interest a little bit more because you're borrowing a little bit more, stakes a little higher, but everything's cool. Everybody's been paying back so far. Everybody still wants tacos. There's still plenty of tacos out there. And you see opportunity to make some money, your boss sees opportunity to make money. So this keeps going higher and higher. At this point of the game, you're making more money off of making the loans than you are on your paycheck, right? You're still using that same $400 paycheck as collateral, but now you're borrowing, $2,800, $3,000, $4,000, right? So now this time Friday comes, like you've loaned out $2,800, right? I'm sorry, you borrowed $2,800. You promised to pay your boss back $35, but you've got $4,000 in collateral, right? Because you have 400 people came to you.
Right.
So you're set to make $500 because you're going to pay your boss 35. You got 4,000. So Friday comes. There's a slight problem, Chris. Because you had to borrow from people you didn't really know. 5 of those people didn't pay you, so you're short $50. And it's like, well, you still made $450. It's okay. All things are all good. But now what we're going to need to do is if I'm going to be borrowing money from people, if I'm going to be lending money to people that I don't know, I'm going to have to charge them more. They're going to have to pay back more because that loan's a little bit riskier, right?
Absolutely.
I don't know if you're going to pay me. So if you borrow 7, you may have to pay back 15 or 20, depending upon what your history is, how well I know you, whether people know you pay back or not.
Do I trust you? The whole bit. Yeah.
Right. So now you're borrowing from more people that you don't know that well, that don't have a good history with you. You're making risky and riskier loans, but the riskier the loan is, the bigger the payoff is, right? So you get to week 5, but this time half the building is coming. People you've never even seen before, right?
Right.
You got 1,000 people in line. They all want $7 for a taco. Now some of them they're going to pay back 10. Those are kind of your premium customers, your repeat customers, the ones with the top tier credit with you, right? They're going to pay back 10. That's the bulk of your loans. But then you got some people you don't really know that well. They got to pay back 15. Some people, they're kind of sketchy. So you tell them, look, you got to pay 20 or 25. And again, everybody's happy to pay it because everybody loves tacos, Chris. Everybody wants tacos.
I tell you what, man, these better be some dang good tacos is all I got to say, because somebody's paying $20 for like a couple tacos that normally cost $7.
Right. Well, so again, but everybody loves tacos, right? And so these are people who couldn't get tacos before because nobody would lend them money because they're not very reliable. But they found someone that's willing to trust them. They'll pay whatever it takes as long as they can get the taco, right? So now you've got $15,000 in IOUs from these 1,000 people, right?
Okay.
You need to borrow $7,000. Now at this point, the boss is like, I don't have that kind of money. So now your boss goes to her VP and she makes a similar deal based on your IOUs. She's getting a bigger advance from her boss so that she can loan you the 7,000.
Okay.
Right. And so this cycle kind of continues throughout the weeks. Now, some people default on their loan. They don't pay, but that's all right because most of the folks are still paying and money's coming in. You get to a point where you're pulling in $5,000 a week on the, that's your net that you get after you make the loans out. Again, that's against that same $400 paycheck, right?
Yeah.
All right. Then you get to around week 10. Now, around week 10, there's a little stomach bug that's going around the office, right? So people are having to take off work. Some people's paychecks are short. Now you not as many people are paying back because they're sick, but they promise you once we get back to work, I'll pay you. Don't worry. No problem because you're still making tons of money, right? The problem though is that this starts what's called a contagion effect because when one person realizes that they don't have to pay back, somebody that's got the money is like, oh, Chris is a good guy. He cut a break to so and so. I'll try to get the same deal. I'll tell him I'll pay him back next week because I want to spend the money on this, or I never really had the money to begin with, or I got laid off and didn't tell anybody.
Right.
But I'm still going to borrow this money because, hey, Chris is a good guy. He'll let me slide. But what happens is that as more and more people realize that they can borrow money and not have to pay it back, now your take is getting shorter and shorter.
Absolutely.
So now you get to a point where you've lent out $50,000 and Friday comes and you get $52,000 back. which sounds like, okay, you got back more than what you loaned out, but you owed 60,000 to your boss. You only got 52,000, right? So the bill's coming due. Well,
Right.
your boss is like, look, you're 8K in the hole. What are we going to do? And you're like, well, I gave you my paycheck as collateral, right? But that's only $400. So your
Right.
collateral isn't enough to cover what you owe. So now you have no choice but to, you basically, what we would call shutter. You go down. You get fired. You lose your job
Yeah.
because you can't afford it anymore.
Yep.
Well, now that you're short, your boss is now short to her boss.
Right.
So now she shutters and closes her door. She has to leave too. And so that contagion just keeps spreading higher and higher, because what you don't realize is that this goes like, 7 levels above you, right? Because more and more these people make more and more loans, more and more IOUs. But when those IOUs started defaulting, now all of these shortages are piling up to the point that everybody now loses their jobs. And now the company has to basically pour in a bunch of money to keep the company going, right?
Right.
That's basically what happened during the 2008 recession.
Oh, wow.
The
Okay.
tacos were houses, right? In the beginning, there were very strict rules around who could qualify for a mortgage. You had to show tax returns or paycheck stubs. You had to prove that you had the income. There was a certain ratios where you had to prove that you earned enough money to afford the house. You had to have some level of stability. You had to have a certain level of credit score.
Right.
What happened was, in the 80s and 90s and 2000s, the banks realized that if what we need to do is, the more mortgage loans that we can make, the more that we can borrow money against those mortgages. And then the more that we can borrow money from other banks or sell off certain assets based on these mortgages being paid. The
Okay.
problem is, what they didn't foresee was that the default rate of those mortgages could reach a point to where it basically makes all their assets worthless, right? Because if I say I've got this bundle of mortgages and I say that it's worth $50 million because that's how much people are going to pay me,
Right.
and I'm going to borrow money based on that 50 million. Well, if those IOUs are mostly made up of sketchy people who don't pay their mortgages, well, all of a sudden those IOUs aren't worth 50 million anymore. They might be worth 30 million,
Right.
which means now, because of that value has gone down, you now default on any loans that you make against, that bundle of mortgages. And so that's what caused the systematic collapse of the banking system, is because they were way too over leveraged on these mortgages that they claimed were good, but actually were useless because it was made up of a bunch of risky loans because of their greed.
So let me ask you this then.
Mm-hmm.
So the banks that were loaning out the money to people like me to buy homes,
Mm-hmm.
mind you, I wasn't one of them. I was still
Right.
paying back student loans at that point in time.
Right.
Uh, were they borrowing money from other banks in order to also continue that loan, just like my boss was then getting money from their boss and et cetera?
Yeah. So there was a lot of borrowing going on, but then there were also, the banks started to create these really complicated financial asset classes,
Okay.
where they made an asset out of nothing, right? So
Okay.
you got, let's say, 5,000 mortgages, and they're worth $50 million, right?
Right.
So I'm holding these IOUs. So what I'm going to do is basically create a security, like almost like a stock, based on this value that I can then trade back and forth in the market, right?
Okay.
And so because I'm holding these IOUs is worth a certain value, I now can trade the eventual payment off of those assets as if it is the thing itself, right?
Okay.
The problem is, if you say, okay, I'm holding 50 million of this particular asset, they're called mortgage-backed securities, right? If I'm holding
All right.
something that's worth $50 million and I want to give it to you as collateral, and I want to borrow 250 million, well, I might make that offer if I think that it's worth 50. But if it turns out it's only worth 30, that means that the collateral isn't even enough to pay back your payments on that 250 million, right? They
Oh,
call it
interesting. Okay.
servicing the loan. So every month when you have to make an interest payment toward
Yeah.
like your mortgage, that's what you call you're servicing your loan every month. That's
Okay.
the amount that you have to pay to keep the loan active. And
Right.
so when these banks are having to pay this stuff off, the collateral is plummeting in value so quickly that they no longer have the leverage to be able to service their loans. And so what
Interesting.
happens is
Okay.
that they default, all their assets crash and go to zero, stock goes to zero, the bank goes under.
Interesting. Okay. So I mean, and also to go back to my student loans I was talking about, I
Mm-hmm,
mean, that student loan that I had was literally owned by like 5 banks. I
mm-hmm,
mean, it kept that my debt kept getting sold to another bank who took it
yep,
on, who got sold to another bank, and et cetera. So I'm
mm-hmm,
imagining that was probably the same thing was happening. Was people were seeing, okay, wait, we may not, they may be defaulting on this, so let's try to sell this to let this headache be another bank's headache,
right,
so we don't have to worry about it anymore. Is that true?
yeah, it's 100% true. And also, they were selling these bundles of loans off to each other, and they were lying about how valuable they were and how what the risk level was.
Oh
Right.
wow.
So you may have 5,000 mortgages. 80% of them might have been to subprime borrowers,
Right.
which means that the risk level would have been very high, but then they would give it a low risk level so that they will preserve the value of it because they want it to be able to continue to circulate that asset,
Oh, interesting.
because they
Okay.
knew that if they show what the true risk of it was, they wouldn't be able to continue to make money off of it, and that would really start the collapse. Their rating agencies, so these are companies that basically give like A+ certifications. So you may have heard of like Standard and Poor's or Moody's. They were in on it too. They were
Right.
giving out these ratings that they at least suspected were inflated because they were pressured by the other rating company. So basically, if you're Standard and Poor's, if a bank comes to you and says, "Okay, I want you to give me AAA rating on this," if you
Right.
refuse to do it, they'll go to Moody's, their competitor, and get that AAA rating anyway. And so obviously, these rating agencies also make money off of how many transactions they run through.
Sure.
So it was this daisy chain of bad loans and mortgages being circulated, and people that otherwise could not afford mortgages being encouraged to go out and get mortgages, continuously refinance. And again, just like in the story, when you got more people out there buying houses, the the prices of those houses skyrocket, right?
Right.
And so people are refinancing and they're saying, "Oh, your house went up in equity 20%, go ahead and refinance." But these people don't have jobs.
Right.
So they
Wow.
refinance to take money out so that they can keep paying their mortgages. Well, the problem is you get to a point where you run out of room and you can't do it anymore.
Yeah.
And then as these defaults start to pile up, the banks are starting to run out of room because you can't sell more mortgages fast enough to cover up the losses that you're taking from the loans you're already holding.
My God. Okay. And this was just like this was standard practice. I mean,
Mhm.
this was going on for years before it all came I mean, before it all came
Mhm.
crumbling down, correct? I
Yeah.
mean, this
So
was what, for 3 or 4 years beforehand?
yeah.
Or
So
even longer?
there was a run up. So what happened was you had the dot com crash that was around 2000, 2001, and
Right.
we had a recession coming out of that. Coming out of that is really when you start to see the rise of these mortgage-backed securities started to really kind of ramp out of control,
Mhm.
because again, the banks and the mortgage companies are competing with each other, right? And so
Okay.
if Chase is giving out better deals, they're going to be able to attract more people. They're going to borrow more money, which means more interest payments that Chase can collect, right? There was so much lack of oversight in terms of how risky those decisions were that they were making, because the focus was getting everybody into the housing market to buy houses.
Sure.
Because again, if there's a spike in demand for housing, well, now your home builders, right? They spike. Now you're creating more jobs, construction, lumber, permitting for these zones, more taxes that people are going to pay for property taxes for houses in these municipalities. They're and so it just keeps going and going and going. And so the government's in on it, everybody's in on it. They want to keep that machine running.
Right. And that's why they use that term, being too big to fail.
Right. So what happened was when the contagion got to the point where you have these, 20, 30, 40 billion, $50 billion, $100 billion banks starting to go under,
Wow.
the government realized that if we allow basically our whole banking system to go bankrupt, that would send us into economic depression, similar to what we saw in the early 30s.
Wow.
So
Unbelievable.
in order to preserve that, because I mean, think about it, if our whole banking system collapses, you know, people that have savings can't get their savings out. The money basically goes away, right? All your
Sure.
retirement, your 401k, all of these things are dependent upon our banking system in order to function.
Yeah.
So if the whole banking system collapses, basically the whole country collapses. And so that's where the government made the decision that we need to step in and bail out these banks.
Wow. My goodness. And they had to do it because if
Right.
not, then so many other things. I mean, that was going to cause a domino
Right.
reaction where just so many things were going to fall apart.
Yep.
And man, it's amazing. Just it
Mhm.
started off with a taco.
Started with a taco.
Yeah.
Because again,
Wow.
everybody loves tacos, Chris.
That's true. And everybody likes having a house, I suppose, too. So much so
Right.
that, yeah, it started this. So, wow, that was interesting, Ben. I literally, I've never heard it talked about that way. And to me, that just, I knew it happened. Obviously, I'm old enough where I went through it and whatnot,
Mhm.
but I had no idea what caused it. I just knew that, uh, financially, the United States sucked at that point in time, and we had to get out of it. I didn't realize that the chain reaction that started just by one thing that led to another thing that led to another thing. And so this was a really good lesson to learn about. I appreciate it.
There are certain banks that are now offering basically 40-year mortgages, right? So what
Oh wow.
happens is, if but they're not, you can't buy that. You can't use a 40-year fixed loan to buy a house. But if you're in a home and you qualify for mortgage assistance, you can actually refinance your home over a 40-year term. They call it a loan modification.
No kidding.
And it basically is designed for people, for distressed homeowners, to get a lower payment so that they can stay in their house. Um,
Absolutely.
but so I think that's the next thing that's going to break, but I'll probably save that for another video.
Yeah. Wow. All right. Well, thanks, Ben. I appreciate you teaching me about this because again, this was something that I had no idea, and this is something that we're going to have to continue to look at for the next couple of years. I mean, how long do you think something like this is going to continue to affect us?
It's really hard to say,
Okay,
especially because the government says that we're not in a recession right now.
that's true. Yeah,
I argue that we're already in that recession.
yeah,
I really think that we're going to start to see the tides turn probably starting this summer. And when you talk about housing markets, that's not something that crashes quickly and doesn't
sure,
recover quickly. So I think they're really going to start to see a downturn in our economy starting in the summer. And I think it's going to be a multi-year process for our housing market to kind of correct itself. There's a lot of evidence in the data that suggests that the markets are being manipulated by the government in order to keep people from panicking,
wow.
right?
Hmm.
Yep.
So, and you cannot borrow money from me for a taco.
Loan me $5.
No, no, you buy your tacos somewhere else.
Oh, Chris, thanks so much for coming on and helping me tell this story.
Hey, thank you. I appreciate the learning because again, the only way we're going to be able to do something about it is if we acknowledge it happens and work on it from here. And so it takes just one person to start it. And so I appreciate you teaching us all this, Ben. Thanks.
No problem at all. So I want to thank all of you for watching this video. If you like content like this, please hit that like button and subscribe for more content like this. Thanks, everybody. Until next time.